like to move on now to leveraged ETFs. These are another fun investment idea, quite popular these days. And I actually attended an investment seminar here in the city. So I went to the conference, and it was packed. There was about 150 people there, and they were all there to hear investment insights from a particular so-called expert who had all these wonderful insights and so forth. What I saw shocked me. Basically, there was a lot of technical analysis, which means that this person looks at charts and relies on then basically looking at it like a football play and saying, okay, here's what we're going to do, planning it out like that. So based on this technical analysis, this person put up a list of securities that they recommended, which included double and triple leveraged ETFs. Now, let me just back up for those who may be unfamiliar with ETFs. An ETF is an exchange-traded fund, which is similar in a way to a mutual fund. However, it trades like a stock. Now, there are other differences, of course, but in the most basic sense, that's what you're getting yourself into with an ETF. You can buy and sell it within seconds, and instead of buying a share of GM where you just own one company, if you buy an ETF, you suddenly are the owner of a few hundred companies or a few hundred debt securities and so forth. So as I was at this talk learning about these leveraged ETFs, and by the way, leveraged ETFs mean that they mimic the performance of an underlying index to a certain multiple. So for example, if you have a ETF that's double leveraged on the S&P 500, that means if during one day, if the S&P 500 goes up 5%, this double leveraged ETF, if it's long, will make 10. So in the most basic definition, the underlying index goes up 1, you automatically make 2. Sounds great. Likewise, there's also triple leveraged ETFs, whereas if the underlying index goes up 10% in a day, you make 30. Sounds great. Although these triple leveraged ETFs are extremely volatile and extremely risky, they do have a place as far as speculation, as far as very astute investors and day traders. They love to use these investments to boost their strategy or to provide leverage and get them the returns they're looking for. However, for the everyday investor, for the average Joe, this is like financial cocaine. A little bit may not kill you, but any more than that, and you're going to get yourself in a lot of trouble. Now, what I didn't see at this conference that I went to was the mention of the fact that these securities should only be held for one day at a time, at most. Regardless of the situation, whether you're long-term investor, short-term, high-risk, low-risk, they should only be held for one day at a time. This was never mentioned. So basically, I was looking at a room of 100, 150 people being told to buy triple leveraged ETFs, all kinds, and hold them for extended periods of time. I couldn't believe it. I could not believe that people were being given such reckless advice and told to basically deal with financial nuclear weapons. And the reason I was so taken aback was that if you do hold these securities for longer than a day, the returns actually start working against you in a very big way. And here's actually one example in this article. You can see that, actually, I might have a better example for you. Okay, this is even better. Here I have the triple leveraged ETF. It's FAS. It's the financial bull. It's supposed to mimic the underlying index, which is a group of financial stocks, and amplify the return by a factor of 3. So if the underlying index moves up 10%, we're supposed to make 30, which sounds great. Over time, though, you can see how this can become extremely destructive to a portfolio. I'm going to see if I can get a highlighter here and show you exactly what I mean. Okay, so we can see in the green XLF, and this is over 2 years. We can see XLF is staying relatively close to 0. Of course, it moves up quite a bit here, but we see that it basically stays still for the most part. Not much movement there, and you'd pretty much be in the same situation you started in 2009 if you just held these financial stocks without being leveraged. Now, in the red, you can see FAZ, which is the triple leveraged short ETF. So basically, it's supposed to provide returns in the other direction. So if the underlying index goes up 10%, it's supposed to go down 30, which is the opposite of FAS, which if it goes up 10, it's supposed to go up 30. So basically it's a directional bet, which will provide returns depending on which direction the index goes in. Now, over time, we can clearly see how these returns become completely erratic in terms of tracking the underlying index. In the beginning, there was some volatility here. We got a peak, we have a low here, and then they intersect and completely lose the tracking to the overall index. So the situation that investors would be in, if they actually held this ETF over 2 years, would be that one of them would be down. In the case of FAS, it would be down approximately 60%, and in the case of FAZ, they would be pretty much out of luck, meaning their whole portfolio would be gone. Okay, so this represents the danger here that investors are being put into, and this is what the article was touching upon, in that investors are not being informed of this, and they're holding these securities for long periods of time. They're really feeling the pain. And I had a conversation with a few of the people that were at the conference, and I asked them, was there any mention of the fact that you can only hold these for 1 day? The answer, of course, was no. It's another situation that investors are getting themselves into. They just don't know, or they have a broker that's doing this for them, and they have no idea the possibility of loss that they're encountering. In this example here, it shows you that basically FAZ resulted in almost 100% loss, which is quite incredible. And there's nothing wrong with the ETF in itself. Being a leveraged ETF, it does have some implications in the market as a whole, but for it to offer that kind of leverage and to offer those kind of possibilities for the advanced investor, it actually be really good, because you can strategize based on having amplified returns with less capital. However, for the average investor who doesn't know what they're getting themselves into, these could be extremely, extremely destructive. Now, in their credit, the provider of FAZ and FAS, it's called Direction, they were actually very clear in the fact that you can only hold these for 1 day at a time. And here we can actually see one of their informational documents, and it shows you what happens to your returns if you hold the investment over a long period of time. First of all, they start with saying it should not be held for a day. Here we go. In volatile markets, the pursuit of daily investment targets will have a negative impact on the ETF's performance for periods longer than a single day, as illustrated in this example. So we can clearly see here that the index value starts at 100, and after 6 days ends at 100. I'm going to get the highlighter here so it's a little easier to see. So we start at 100, and there's some volatility, not that much, and then we end up at 100 after 6 days. So basically, there's no movement in the underlying index. If you just invested in the index fund, you'd be basically where you started. You could see the daily returns of the index, the cumulative return times 3, and this is how the ETF calculates its actual returns. So the triple leveraged fund daily expected return is outlined here, and it shows you the fund's net asset value, which starts at 20 and ends at 1909. Now, this is where the fact that these securities reset on a daily basis really takes hold. The index started at 100, ended at 100. However, we lost money. So there were no returns being amplified by 3 or amplified in reverse by 3, nothing like that. Basically, the nature of these investments over time lend themselves to being quite close to being random as far as the returns. So even though nothing happened to the index, we lost almost 5% of our investment in six days. Is it possible to lose that much? Absolutely. Is it possible to lose a lot more? Absolutely. So these are volatile securities. They are for advanced investors. But I have to say, the disclosure that this company has done has been very extensive, and it shows you that these securities are not meant to be held. However, whether investors recognize this or not, it's going to be a different story.